So last week I had 3 trades. 2 of them were winners, 1 of them was a loser. But obviously on today's video, I'm going to be breaking down one of them which had my favorite trend continuation setup, and that was on USD JPY, because I'm pretty sure you don't want to see a losing trade, do you? Well, if you do, leave a comment in the section below and I'll let you know how I take or how I deal with losing trades. But for today, let's analyze my trade on USD JPY. So guys, here we are on the monthly chart, and as you can see right off the bat, very obvious selling going on in the market, which started from November of last year, and then you see December we had very strong momentum to the downside. And for me, my expectation for this month was that same bearish momentum that we've seen over the past 2 months was going to carry on and translate over into January. So that's why I had, on the monthly time frame, I basically had a bearish bias coming into the market. Also, if we go onto the VSA, what you can see is that on the VSA chart in October, we had a possible hidden selling going on. And basically what this is a level or up bar showing an increase in volume, supply, or low volume, basically no demand. So you can see we had a no demand, buyers basically getting trapped, and then massive selling coming into the market in November, which then translated over to December. And as I said before, I was basically expecting the month of January to carry on this bearish momentum, this bearish sentiment. So dropping down to the weekly. One of the first things you can see is a counter trend line break right from this point. You can see those bearish momentum that we had on the monthly time frame literally breaking this counter trend line, as well as several psychological whole number levels. We can see that when price broke this 140, proceeded to break the counter trend line, and then we had this retest here for 2 weeks. Price couldn't break back above the trend line, and then price carried on to push towards the downside. Now, after seeing this on the weekly time frame, I had more conviction that this was a bearish market. Then I dropped on to the daily time frame. On the daily time frame, you can see that price proceeded to break the 130 psychological whole number, and this was basically one of the levels that I wanted to key off this week coming into the market. Seeing that price had a massive rejection on this level on the 18th of January, I was expecting this level to basically hold, because we can see, looking back, that these other psychological whole numbers, once they're broken, they tend to hold. And then the trend line to add to the bias, basically this market, there was no way in my mind that this market was going to keep going up. But in order for me to take a trade, I need more confluences, and this is just basically multi time frame analysis. So on the daily now, after looking at the multiple rejections, what I decided to do was go onto the 4-hour time frame. Now on the 4-hourly time frame, coming into this week, what we can see is that we had a counter trend line from about here, and we can see how, let me just adjust this a little bit more, because I like to use the wicks. So you see how basically market touched here and then it rejected from here. I like to adjust it so that I use this wick, and you can see market proceeded to bounce off of this line, off of the trend line right here, and then I'll use this wick now for my second touch. So there we are. So what we see now is, coming into Wednesday the 25th, which was the day I actually took this trade, you can see we had a bullet or bearish engulfing, breaking not just the counter trend line, but also the 130 psychological number. So as soon as I saw this break of the 130 psychological number alongside the counter trend line, already in my head I was like, okay, well, the bears are coming into the market and we're having a strong momentum push to the downside, similar to what we saw here and here. So now jumping down to the 1 hour time frame. Moving on to the 1 hour time frame, what we can see, if I go down to the 1 hour time frame on the VSA chart, is you can see that on the 25th, which was here, you can see we had a trap up move. And this indicator is based upon the action of two bars. The first bar is up and closing off the highs. The next bar is a widespread down bar closing near the lows with its high higher than the first bar. This is designed to lock traders who are long into poor positions. And we can see evidence of that by looking at the trend line, because what happened was as price came and kept touching this trend line, you can see that buyers were basically getting involved into this market thinking that the market was going to go up. So you can see that this bar right here was basically the start of that trap up move that we saw on the VSA chart, because what happened was buyers were coming into this market thinking that the market was going to push off from the trend line, but then immediately sellers came into the market and that was the trap up move. And what happened was all these people who were basically buying the market began to exit their longs, and that's why we had such a drastic push below the psychological whole number. So that was one of basically the confluences that I saw on the 1 hour time frame, which was basically letting me know that sellers were basically getting heavily involved into this market. And plus the break of the counter trend line was major key for me. So once I saw that, I dropped down to the 15-minute time frame, and on a 15-minute time frame, what we can see, what you notice is that price, not only the price break through as soon as London opened, but price also held below the trend line and the psychological whole number for the first 4 trading hours of London session. So I'll just mark that up for you just so that you can see what happened. So this is 8 a.m. London time. And then if we drag this down all the way to 12 p.m., you can see the sellers were not budging, because for 4 straight hours, we had nothing but sells. But what I want to bring your attention to is, look at these 3 massive selling candles. What these represent is basically volume imbalance. I know that those who trade or study ICT call this a fair value gap, where it's nothing but just sellers. But in volume, this is basically volume imbalance, where there is way more sellers than buyers, and buyers couldn't even have the opportunity to step into this market. That is basically selling aggression. So not only do we have this break of the counter trend line and the break of the psychological whole number, what we also have is aggressive sellers coming into the market. And that is basically something that I look for when jumping in, because it shows me that not only is the trend downwards, going in a downwards direction, but also we have a lot of participants who are also willing to sell this market. So, and then to add to that as well, we can see that price actually held, like I said earlier, for 4 hours below these major levels. So not only was price holding below these major levels, what we saw was where we had these imbalances, you saw that the bulls tried to push the market up, but immediately these aggressive sellers came back in and pushed even more aggressively. So you can see we had this bullish momentum trying to break above the 130 psychological whole number, but then we had another aggressive selling pressure to the downside, right? So for me, this was a no-brainer. It was clear that I was going to be selling this market after seeing the multiple confluences that we've built up from the higher time frame going into the lower time frame. So now all I need to do is just draw my Fibonacci, because I can see that we had this volume imbalance right here. So what I was expecting was what happened earlier at this level. I was expecting it to happen again when we get back up into this area. But not only to add to the aggressive sellers, we also have the 130 psychological O number that adds more confluence to these initial aggressive sellers. So what did we get? So we actually got a retracement as I was expecting, and you can see that on the before picture that I posted earlier in the video. You can see that we had price retrace, which is what I was expecting. This area right here was basically where I was expecting price to come to, where the aggressive sellers was, but also we can see that price is giving us an entry opportunity at discount of a 38% of that initial daily move that we saw earlier in the day. So once I saw that, and I saw that price retraced to this 130 to this 130 psychological number, as well as the 38.2% retracement, what I proceeded to do was look at my VSA chart, because I wanted to make sure that there was no buying coming into this market. So when we drop down to the 15-minute time frame on our VSA chart, what we can see is at that level where price retraced, where the aggressive sellers were, we saw a VSA no demand. And basically the VSA no demand is an up bar on narrow spread closing in the middle with low volume or volume lower than the last two bars. It can be a down bar if the high is higher than the previous bar. This shows the professional money is not interested in higher prices at this time. And clearly the professional money were not interested, because we can see that we had aggressive move twice to the downside. When the bulls came, they immediately got taken out by the sellers. And once again, in this level, we can see there was a no demand. And as a matter of fact, going back to the VSA chart, you can see that when buyers came to the first initial aggressive sellers, there was no demand. And then they tried again and no supply coming in on the second one. So guys, for me at this point, it was a clear sign of entry for me. So what I decided to do, guys, was after I saw that price retraced and I saw this massive rejection of the 130 psychological number followed by an engulfing, I decided to get involved, because this engulfing for me was just confirmation that price was going lower. We were going to see lower prices in the market. So I got in after this engulfing candle, and then the next step was for me to draw my targets. So basically I tend to use the 0.27 fib extension as my target. And you can see right here, price immediately, as soon as price came down, we had a massive bounce. But what you can see as well that I like about this trade is it was a 1.7 risk to reward. So nearly a 2-to-1. And this happened in the space of a couple minutes, you know, like 2 hours. And that was the trade. I mean, you could shoot for as well. If you wanted to take second targets, you can shoot for the 0.618%. But what I like to do is I like to scale out early. I like to get in and get out and be done for the day. And that was literally what happened on this trade. So guys, as you can see, multiple time frame analysis, using volume spread analysis, using momentum to guide me in the direction of where this trade was going to go. And that was basically my trade on USD JPY. It was a nice 1.7 risk reward. Let me know, guys, do you guys use volume when trading? Or if you don't, tell me why you don't use volume. And if you'd like to know more about volume spread analysis, leave a comment in the comment section, and I'll make sure I try and do more videos explaining volume spread analysis. This is by far one of my favorite ways of trading. You can check my previous videos. I use volume spread analysis all the time in trading in the direction of the smart money. A lot of people talk about smart money, but what you need to understand is Smart money are basically the guys that are pushing the market in one direction or the other, and all I'm trying to do is basically look for clues that show me what direction or when they're taking part in the market, and I basically try and jump in to capitalize on that move. And once I get in, I'm basically getting out. I'm not greedy, I manage my trades wisely, and I basically hop out. But that'll be it on this video, and I'll see you guys on the next one. Peace.